Those can also be some great things that can be designed in that can also reduce the footprint of your least productive employee, which is the IRS. And so
Right.
those can be some things that can reduce the tax drag on that by making some great benefit packages available that incentivize the more productive employees to stay.
Yeah, the IRS is often, let's say you have two co-founders, the IRS is often your unwanted third co-founder. At least maybe
Exactly.
that's how they see themselves. I'm not really sure. But
Hmm.
that's actually a very good point on the business benefit side in a way, is that you want to make sure as a founder that you're keeping your personal and your business expenses separated, even like straight from the beginning. Like you want to make sure you're taking advantage of which expenses can be ran through the business and written off in that way. And you want to make sure that you're doing that accurately so that you don't have a surprise come tax season from the IRS.
Exactly right. I know this is kind of going backwards for just a second, but also some of the things we've seen is you were talking earlier about some of the investors that may come in. And oftentimes that investor may be positioned as the silent investor, but I know we've seen some circumstances where the silent investor becomes less silent and wants a
Right.
more active role in the business. And there can be some interesting dynamics that play out there. And so that's also something we encourage folks in the design of some of the strategies as well as some of the exit planning is to say, how do we invite some of those folks out that just we may need to invite out, whether it's the aggressive outside investor or whether, you have the astronomer CEO who gets caught on the Coldplay kiss cam. How do you reflect the value that they provided up to that point, but also very quickly find those ways to invite them out of the business without taking the business through all of the drama that can accompany those kinds of either ethical or financial lapses that can occur with folks.
Yeah, and that's exactly why nowadays most investor agreements are written as safe documents. And that's because the safe documents are basically convertible debt. And it protects the investor because they get paid first in terms of a bankruptcy event. But it also protects the individual, the founder, because they're able to maintain more present equity in their company and therefore maintain the decision making.
Yeah, and that's a great point because there's something else we see is that oftentimes in that pursuit of the first or second investor, the businesses may be willing to give up way too much equity just to get that initial capital coming in the door. But now that sets the baseline for everybody coming thereafter to say, okay, here's what we expect as a minimum coming in the door. And you can very quickly run out of equity to give away and potentially lose the direction of the business and the majority ownership of the business as well.
Right. And there can be some tax concerns with having more equity as well. That can become a problem. I know, for example, the state of California is teasing with a wealth tax this year. There's different ways that it's being written and hasn't passed yet, but it could be just strictly dependent on your equity, which once again, from the beginning, your equity does not equal how much money you have at your disposal. So that can cause a problem with a surprise tax bill that you, as a founder, cannot afford because you don't have any liquidity. And then it also could be tied to voting shares, which can be an additional issue because you can structure the shares in your company in different ways in terms of the actual raw equity and the voting capabilities. So that could be an issue as well, where like not only do you not have the liquidity, you don't even have the net worth on paper, and you still might be hit with a surprise tax bill.
Yeah, it's a great point. You're seeing that, I know New York City's been looking at a similar one, Australia, and I think Norway have also recently passed some tax liabilities for unrealized capital gains on the growth in the business. There's a lot of things there that are causing a lot of capital to flee some of those areas right now. So great points.
Just in the vein of tax concerns, some other things that founders should be aware of is keeping the personal and business expenses separate from the beginning, and the second being like surprise wealth taxes. What state or what country are you located in, and like what legislation is being flirted with there. And then another one can be when you grant stock options or grant restricted stock units. Both those have different ways that you need to file it with the IRS, and you need to have a 409A valuation on file. Otherwise, you can get hit with tax penalties. So for the stock options, you need to make sure there's a 409A on file. And then for the restricted stock, you need to make an 83B election. And if you fail to do so, then all of a sudden the IRS becomes your silent co-founder again.
That's a great point. And I think we also see as well for those businesses that I think are in the sort of $10 to $50 million range with the qualified small business stock, if they're C corporations, there can be some very unique capital gains installation, but you have to make those moves at particular windows of time. Those can be some great framing conversations. Well, with that in mind, obviously these are conversations we have on a regular basis, within Forte Impact, but what are some of the ways that you see that our team can help folks in the business owner space?
I think the first thing is looking at the big picture. Like we can organize all the aspects onto, let's call it a financial dashboard, where founders can connect their personal goals, their business trajectory, and their personal finances as well, like all in the same place, and have a better collective idea of how do these things work together towards pursuing those long-term goals on both the personal and business front. And then on the personal front specifically, talked about making sure that you have a runway plan and that you're paying yourself appropriately so that you're not making desperate decisions along the road, and making sure that you have a personal financial plan in place. And then we can consult with the founder's tax and legal team so that they're designing their equity and compensation packages appropriately, and making sure that we're avoiding any surprise tax bills. And last thing, when those liquidity events do happen, making sure that we have a plan to diversify those funds within their personal portfolio.
Absolutely. And I think as well, that's a great segue into some of the things we do with folks as we have our Exit Like a Billionaire series. And the idea is, what are the mistakes that the billionaires don't make that a lot of other business owners do when it comes time to the liquidity event? But also, what are some of those steps that need to be done well in advance of the announcement of a potential exit? Because as soon as the exit's announced or rumored, there can be some pretty significant clamps that start to fall into place to say you've just lost a lot of maneuverability. So we want to get ahead of those events, whether someone looks at this and says, this is the multi-generational business I'm going to hand down to the kids and grandkids, or if this is a 3-year in and out, just want to build it and then sell it. There's a lot of things that can be designed there that can blunt the tax exposure, but also make sure that you have maximized maneuverability.
Yeah, and then once again, besides just the planned exits, there's also all the unplanned transitions we talked about too. So making sure that, once again, working with the legal team, that there's a buy-sell agreement in place, and then our team can help with those funding mechanisms, making sure that that buy-sell agreement is funded if any of those unplanned circumstances do come up.
Absolutely. Well, fantastic. Well, Alec, always enjoy our conversations. Again, this is part of what we've enjoyed having you on the team for the last decade and just getting the amazing insights. I know I say all the time, every time we chat, my IQ goes up a couple points. And so
Thanks.
I know you're going to help catapult a lot of folks forward as well with your insights. Thanks for joining us. We're looking forward to having some more conversations with you. Again, feel free to reach out to us. Alec and I would love to have those conversations with you regarding the types of work and planning we do with business owners all around the country and some of the ways that we can help optimize that for you. All right, until next time, thank you, Alec, and we look forward to catching up with you soon.
Looking forward to the next one.